Good morning. Welcome to CATEX TV. My name is Frank Fortunato. Today is Tuesday, April 30th, 2013, the last day of the month. We have some more details on yesterday's plane crash at Bagram Air Force Base by Kabul, Afghanistan. Apparently, the plane that crashed shortly after takeoff was a Boeing 747-400. It's a big plane. It's probably only the second such aircraft of its type to have crashed. The plane was owned by a company called National Airlines, which is a cargo carrier. It was going from Bagram Air Force Base en route to Dubai, the United Arab Emirates. There were 7 people on board, all Americans, and they were all killed. The plane was carrying vehicles and routine general cargo. National specializes in moving freight for the military and businesses. The cause of the crash is unknown at this time. The Taliban quickly claimed credit, although military people say they were nowhere near the area. The National Transportation Safety Board from the United States is working with the Afghan Civil Aviation Authority in an investigation. The new regulatory regime in Britain, the Prudential Regulation Authority, is beginning to blast the cost of Solvency II. The chairman of the PRA, Andrew Bailey, in a letter to the head of the Parliamentary Commission on Banking Standards, Andrew Thierry, 2 people named Andrew, Mr. Bailey said that the European regulations make no allowance for the value of money. It's lost in detail and is vastly expensive. Bailey says that the cost for the UK could end up at $310 million US a year in order to make the UK insurance industry compliant. This would translate, according to Bailey, into a 0.1% increase to all insurance costs in the UK to cover that. Mr. Thierry, for his part, emailed back saying strengthening and harmonizing the regulation of the insurance sector across Europe could bring significant benefits, but we haven't seen any yet. He said even now no one can be sure what it will add. The 2 went on further to have a subsequent email discussion, all of which was released to the press, in which Mr. Bailey said, he's the head of the Prudential Regulation Authority, that Britain is going to impose a higher standard on its insurers and reinsurers and banks than Solvency II from Europe requires. He said, we're going to use, quote, early warning indicators, unquote, in our supervisory work. And it's going to put together a tougher version on capital adequacy than the EU is going to impose on the continent. The PRA wants to avoid a repeat of the Equitable Life scandal in Britain, which saw the world's oldest life insurer nearly collapse after making promises to policyholders it couldn't keep. Keep in mind that London is the biggest financial center in the EU. Now, one of the other interesting things that came out of this exchange between these 2 men is that if Britain imposes add-on rules, the country could be taken to the European Court of Justice, which then would have the power to force the Brits to remove those rules. The discussion became quite detailed, in which Mr. Bailey said Solvency II has been a decade in the making, but it's been delayed now at least until 2016 because of disagreements. And then he went on to say, quote, in particular, it's unclear to us that the French will now be able to agree to any directive that we consider prudentially acceptable. He said Germany is also looking for a long phase-in of a decade or more. The British can't wait. This is very interesting. There was another big bomb blast in central Damascus in the district of Marjah this morning. It killed 13 people and injured over 70 others. This is just a day after the Syrian prime minister survived a car bomb attack. No claim yet as to who is responsible, although it was a military stronghold. The Berkshire Hathaway Aon quota share deal in London continues to generate controversy, and Validus' CEO Ed Noonan never won at a loss for words. During the quarterly conference call on the company's earnings, began to talk about it. He said Berkshire Hathaway is, quote, free riding on the 325-year-old Lloyd's franchise and professional expertise with its unseemly Aon quota share deal. He said to turn around and free ride on the 325-year-old franchising, its underwriting expertise, its claims handling, and professionalism is frankly unseemly. Noonan also blasted the deal from a commercial standpoint. saying it has left the firm's executives, quote, scratching our heads. He said, quote, the idea of blindly accepting all risks with no underwriting whatsoever is certainly not a deal that any Lloyd's underwriter I know would enter into. Noonan said that Validus was confident of its ability to defend its London book as it led a high proportion of risks. Now, I'll tell you, this is going to continue to generate controversy, and it's only a matter of time until some other risk bearer does it. That's the news for today. If we have any breaking news, we'll come back and tell you. Thank you for watching, and we'll see you tomorrow.